Hey, welcome to the course. Nice to see you. Let's start right into it, right? So first, we will talk about market structure. It's pretty important you grasp it up because this is the most important concept in order to understand price action. If you understand this concept in price action, everything else will end up pulling together, okay? So listen closely. If you do not understand the first time, no problem. Go ahead and watch it multiple times. So first, the market structure is gonna be this way. Like this, an impulse, retracement, impulse, retracement, impulse, retracement, impulse, retracement. Okay, that's gonna be our market structure. Of course, sometimes it's not gonna retrace all the way here. Sometimes it might retrace like this, okay? Sometimes it might do that. But overall, the point is not how long the retracement is. The point is seeing the structure, that is the impulse, to the retracement. And from the retracement, the next impulse. Okay, that's our structure. So let's go over a few examples and then we'll go to the next thing. Basically, we can see over here. Let's see. Impulse, boom. So this is our structure. Our structure is this. We go to the 0.50% of the retracement, which is very important. That's where we're gonna be entering later on the strategy. 0.50%. We see this, we like this, we continue lower, we take the low. This time we broke this structure because this was our high. However, we broke structure and we're in that type of ranging market over here. So no real view where we're going, okay? Also, this will be our new structure. We will be looking for this to hold the 0.50%. So as you can see here, 0.50% goes a little bit, but ends up not working and going lower. Right? Let's see a few more examples. Here we take this high, but we're still in a downtrending market. One point that you need to grasp up is not because we just have a breaking structure, it's gonna change and we're now gonna go all the way here like this and continue our trend. No. In further points, we're gonna be talking about liquidity. And that's a very important point to talk about when we're seeing structure. Because many times we will break structure to generate liquidity but end up going the opposite way because there's higher time frames such as the daily and the weekly, which will have bigger weight on the price action than an hourly chart. With that said, let's continue. We can see this is a structure, 0.50%. What does it do? Rejects, goes lower, but ends up going past through it and going through it. We usually want to see 0.50% react on the price. Now we have this structure. As you can see, 0.50 goes higher, fails, goes lower, then we have a big reaction, then we continue, and now which is our structure? This is our structure right here. Okay, so now we have this current structure. I think you by this point should have understood pretty much what structure is and how it looks. It's big impulses to where price stops and then retraces. Now let's talk about a change in structure. Change in structures will look like this. Okay, change in structure will be we break the previous low of the bullish structure, then we retrace to a premium. We'll talk about that later on, but it's above the 50% and continue to break the lows. In a bullish structure, we break highs and make higher lows. That's how it works. And on a bearish structure, we break lows and make lower highs. That's how structure looks on both ways. Okay, now let's look for bearish structures. Okay, so here, structure of our big impulse, boom, break it with big impulse down, displacement. What do we do next? We go to the 0.50% right here, touch it, reject, go lower. What do we do next? We go over, pretty much almost taking the high, but eventually reject it. Again, what do we do? Same thing, almost took the high, but eventually went lower. Now, do we count this as our structure? Not really, because does this look very strong to you? No. Which would look this. So 0.50, reject, but end up going higher, lower. Now, here we have what? These very small impulses. Sometimes price action will look like this, but I'll probably wait on most of those and wait for a big impulse such as this. In this case, it didn't even retrace all the way here, and sometimes that will happen. Okay, but that's how a bearish structure would look. You want to see big impulses down, you want to see retracement, continuation lower, and this is how a change in structure would mostly look to you. Most of the times we will have a range, and then we go for the lows, we go higher, then we end up going for the lows again, and then we have the big impulse. That's when we have the big impulse after taking lows multiple times, which we will call liquidity. That's when we know it's most likely a change in structure, at least for the short term. Okay, not a change in a trend, but a change in a few days of structure, which we can take multiple trades in. Okay, this time it doesn't retrace all the way there, normal, like I mentioned. Which would be our structure? Well, it would be this. We retrace, go higher, again structure would be this. We didn't go all the way there, and we go higher, boom, and here we're just in a ranging market, not really displacements. Then we go lower, we go higher, range, like I mentioned, pretty hard to guess in these kind of low volume places. Most of the times I would recommend for you to wait for high volume structures, such as this, okay? I would recommend you to wait for those, because most of those times you can see, as you develop your path, then you can guess when a market is likely to reverse, such as in this case, or when it's likely to continue higher, such as in this case. Okay, but with that said, that was our structure class, and watch it multiple times if you didn't grasp it. Okay, so now we're gonna be talking about fair value gaps on this case. What's a fair value gap? Fair value gap, it's a way of seeing real displacement, real institutional buying or selling. Okay, so fair value gap will be the price in which there's no intersection of 1, 2, and 3 candles. Okay, 1, 2, 3. when the wicks of those candles do not intersect, okay, and we have all of these volume, that's our fair value gap. Okay, which else would be a fair value gap? Right here would be a fair value gap. Okay, this is a fair value gap. Yes. This is a fair value gap. Yes. This is a bearish fair value gap. Yes. Okay, that's fair value gaps. Such as this is a fair value gap. Okay. Now, with that being said, okay, what are we looking for? So a fair value gap, which we're looking for, is showing us real displacement. When I mean displacement, I mean impulses, big impulses. So we want to see fair value gaps where, if we are in a bullish market, we want to see price respect fair value gaps where below 0.50%. Okay, we want to see it respected below 0.50%. We do not care about the ones above, such as this. We care about these ones. Like here, we see a big impulse. That's when we know, okay, fair value gap is being respected, right? For example, take another one. Right here. This, when, if, both words, when and if we get over here, we would want to see this being respected because it's below 0.50%, especially this part of the fair value gap. Okay, this part, all of this, right? We want to see price not close below it. That's what I mean respect. We don't want to see a price closure below this fair value gap. If we close below this line that I marked there, it will be mostly bearish and we will end up going for all of these lows. Doesn't mean we're gonna change structure, but means we're probably gonna get all of this liquidity and then we might change structure again and continue higher. But we don't care about that later. We care about the current trade. So take another example. Where's the fair value gap? Fair value gap is over here. We want to see price respect, right? We want to see the price respect that fair value gap, which ends up happening. And we do not care if price closes above this fair value gap. Okay, why? Because it's not in a premium. Since it's not in a 0.50% above it, we do not care. Fair value gaps are pretty important, but why are they important? Because they can show us how price is moving. If we can see how the order flow is moving, such as here, which we end up closing above here, right there, we end up going for the highs, and then what? We go lower. Yeah, well, we don't care. We care about the current trade. Okay, same thing happens here. What's the fair value gap we want to see respected? The one here. So we see price closing above and not really respecting the fair value gaps, neither the 0.50%. So price ends up going higher. Okay, that's fair value gaps. That's how we use them. We use them to see how order flow is playing out, and we use them to see if price is actually having big displacements. Because look at all the times there's big fair value gaps. Price just continues lower and lower, right? Price just continues lower, going lower and lower, or going higher, higher, higher. If there's no fair value gaps, there's no displacement. If there's no displacement, there's no trade. Okay, so that's fair value gap. Now we're gonna be talking about order blocks. So order blocks is a topic which most of the people care a lot about it, but me personally, I don't really even take it into consideration. Rather, there are some particular cases. However, it's an important topic for some people because some people do implement it into their strategy as a key concept. It's a key concept of smart money concepts. However, most people will end up choosing between fair value gaps or order blocks. Me personally, I go for fair value gaps. However, I have students which prefer order blocks. It's your personal opinion, there's no better one. However, I will teach it to you. So, same thing, we're in a structure. In our structure, there will be down candles. Those down candles before key concept, key word, before the big expansion and the new change in structure will be our order blocks in a bullish market. The down candles. Why? Because who was buying before the big movement downwards? Well, they were buying in the down candle. Why? Because they were buying as price was going lower. As price was going lower, the big people, they were buying more because price is cheaper. So they were buying cheaper. So price goes lower into this order block and they will get more orders, which happens here. Ends up going higher. Again, same concept on the downwards. We will have this as our order block. Okay? However, price does not go all the way there. You see why sometimes I say I do not use it? The people that use order blocks will have a higher risk to reward. Why? Because they will end up getting inside the trade here with a stop loss here. Or inside the trade here with a stop loss here. However, the people that trade the fair value gap will end up getting, let's say, for example, here. And most of the times they will get into the trade. The people that play the order block will not get into the trade, such as it happened here. However, we can see that in other times it will end up entering the trade, which they will get a higher risk to reward. Here we see price going into the order block. Remember, down candle before the change in structure. Down, touches it, goes higher. Perfect for you. Same thing. Here, order block, touches it. Here's the structure. Higher, touches, higher. So the people playing the fair value gap, they will end up getting into the trade, for example, right here, let's say, or even at the top of the order block, right there, okay? That will be someone playing the fair value gap. However, the order block person will enter here, which will get a higher risk to reward, as you can see, right here, 4.64, and the fair value gap 3.5. So the other one will get 1.1 more risk to reward. And that's in this example. In the other example, as this one, look at the risk to reward. The risk to reward was 4 risk to reward, and the fair value gap person, let's say he entered right here, he would get up what? 1.56. So you can see he gets 2.5 more risk to reward. 2.5 risk to reward more than the person from the fair value gap. So of course sometimes it will pay to go into the order block. Perfect, you can use it. However, most times it will not touch it. In ranging markets such as these ones, which is not very clear, it will touch the other blocks, okay, in ranging markets. However, in a trending market such as this one with big displacements, it will not go all the way here most of the times and then go lower. It will sometimes, as we've seen multiple examples. However, you will end up missing a lot of trades if you try to do that. So you can know when to use order blocks, or you can choose one and not change your outcome. Doesn't matter what market you're in. Okay? That's what you need to know. Let's give a few more examples. So here we see trending markets, order blocks. I would do all of this order block. We never went into it because why? We're trending. We're going lower. This is our structure. We touch the fair value gap, not even the fair value gap, just the 0.50. We react to it, go lower. Same thing here. 0.50. We go to the fair value gap, yes, for barely. Okay, lower. And as you can see, that's how price moves most of the times in trending markets. In downward markets, the order blocks will be the up candles, right? I want to find some examples because as you can see in trending markets, most of the times we will not touch the order block, as I already mentioned. So that's why I do not use it. However, we can find some examples in extent, but it's hard to look for them once we're trending. In a downward market, right here. Okay, so this would be our order block, as you can see. We go up, there we have our fair value gap, which we respect into certain way. We never actually closed above with strength, you know, like this, and then boom, reacted lower. And price was going into the order block in this case and respected the order block, right? But most times it will not do that. But this is our order block in a down case. And here, for example, we have more order blocks right there. As you can see, in this we go for the order block in the trending upwards market, right? Because our order block will be this down candle. Then in the down market, we have our order block right there. Order block is not only one candle, okay? I want you to understand this. Order block is the last few candles. So in this case, of course, I use the fair value gap because I already mentioned I use it. But if you were to use the order block, you might think to yourself, okay, what's the probability of going to the last up candle, right? Like going all the way here and then just collapsing. Okay, it might do it. We've seen it does it. But also you can consider using all of these candles, right? All of these candles, you can use them. All of these right here. That will be also your order block because it's a block, it's not only one candle. Same thing here, it's not this candle, not this, it's all of these down candles. Some point that I want to make clear, all of this, which you see doesn't end up going to. But that's the order block. So it's in a upward markets, it's the down candles. In a down market, it's the up candles. Because why the up candles? If we're thinking about price going lower, where did the people sell? They sell once price was going higher. So that's the order block. However, as I mentioned, and this will be the last time, choose wisely when to use which. In trending markets, most of the times I recommend fair value gaps. You will not get the order block, and once you get the order block, this will happen most of the times. So fair value gaps are the cleanest, they're the best in my experience, and I would stick to them because you will have more trades and you will know when you're wrong in a trade to exit early without having a loss. So now we're going to be talking about what it is, this pretty important concept which you already heard me say, premium and discount. So premium and discount, it's basically, premium is everything above 0.50% and discount is everything below 0.50%. When we're looking for trades, we're looking, if we're in the long side, we're looking for discount. Why? Because we want to buy when price is cheap. Cheap to what? Relatively to the previous move. The structure. So we want to buy when price is cheap. Once price is cheap, we can start looking for entries all over here. Okay? We do not look for any entry here. Once price is here, no entries. Price can do whatever it wants. It can continue going higher. We do not care. Okay? We don't care if price continues and continues higher. What we care is once price goes lower. Once the price goes lower, we are looking for trades. If it continues higher, we'll just look for the new structure. Once we have the new structure, we enter the trade, right? That's what we're looking for. Now, in the short side, we're looking for the opposite. We're looking for anything above premium to look for shorts, and anything in a discount, which would be below 0.50%, we're not looking for any short because price is not cheap. Price is not expensive, sorry. Price is not expensive. And if we're selling when price is not expensive, we'll end up regretting, right? We want to sell when price is expensive and we want to buy when price is cheap. That's the key concept. Also, key concept, we do not care, like I already said in previous videos, if there's a fair value gap or order block, for example, in a discount when we're in a premium market, in a down market, we only care about the PD arrays. What's a PD array? Premium discount arrays. So we only care about the PDAs that are on a premium. And that's what we want to see price respect, price displays from. If we see price do that, we see that order flow is on our side. And what do we do if we see order flow is on our side? We continue with our down bias. Same thing here. We do not care about anything that price is over on what? On a premium. So we wouldn't enter here, 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 nothing. We would only enter here, below here. Same thing happens here. In this case, we take the high, we end up going lower, which is a very dangerous sign. And what will be our structure? Right here. But now, do we have displacement? No. So there's no trade there for 1 point. Because did we break this structure with displacement? No. So there's no trade. I already mentioned, no displacement, no trade. You see this, you exit if you were all the way from here. Because we took this high, we end up going lower, no displacement, you're done. Okay? And that's how premium and discount works. So basically right here you have this structure, we break it. Now you have this structure, we end up almost taking. Now what do? We go lower. I will take this structure. Why this? Because we shouldn't go all the way here again. This high should be respected. Now what do we have? We have this fair value gap. We also have this high, which is some liquidity. And we end up touching the 0.50, which is a premium, and that's what we want to see. You could end up even waiting for the closure and, for example, going with a tighter stop. but in my opinion it's better just to enter directly at there with a bigger stop, because markets are volatile and you do not know if it touches it and then goes higher, touches your stop, goes lower. Okay, so keep it more simple, keep it with the rules. Okay, with that said, that's premium and discount, pretty important topic. And go into your charts, see it, see how price reacts, and start implementing. Okay, now I want to talk about liquidity. What is liquidity? Okay, so for liquidity I like to go to weekly charts, for example, because liquidity most of the times will be at higher time frame points. Which are higher time frame points? Previous higher time frame highs and lows, which are previous week highs and lows. So there's a lot of liquidity at the previous week high, and there's a lot of liquidity at the previous week low. Also, there's a lot of liquidity at swing points. What's a swing point? Swing high is, because I didn't explain this, if you don't know, a swing high is this, for example. Take it into consideration. So a swing high, well, this is hard to grasp. A swing high is basically, look at my cursor, is one candle, two candles, three candles, the candle that it's the highest among three candles. That's a swing high. So this is a swing high. Okay, that's a swing high. Now that we know what's a swing high, we have this swing high over here. So this has a ton of liquidity. Why? Because people put their stop loss at swing highs. And what's a swing low? So you understand, swing low is the opposite. 1, 2, 3. The lowest of the three candles. 1, 2, 3. This is a swing low. Okay? You see how higher. So higher, lower, higher. This is a swing. Such as this is a swing as well. Okay? This is also a swing low. Now, there's swings to swings. There's structure swing lows, which will have the most liquidity. Structure swing lows, which what are those? The swings that made the big movement up. Okay, that's our structure swing low. And there's just swing lows, such as this, which will have liquidity. Also will have liquidity. Why? Because there's lower structure points there. There will be, in the 1 hour, there most likely will be a structure there which hasn't been touched at all, and price has never gone over there again. So there will be a lot of people which trade, for example, support and demand, or whatever you want. I don't know what other key concepts they might do, but I know most people tend to do support and demand. That's the most common among retail, but this will be counted for them as their support. As you can see, it does play sometimes 1, 2, 3, it does touch it, but eventually it breaks it. Okay, eventually price trades through it. Okay, price trades through it, goes lower, so it has no utility. It's just a point of liquidity. That's what it is, a point of liquidity, because some traders will put their stops there. Okay, that's the swings. And also for the down, there will be swings which will have a ton of liquidity in the down structure. Okay, for example, here we broke structure. What will be our structure right here? This is our structure. So we go higher, we touch this order block, we go lower. Okay, well, then what do? We have this structure, we break the structure on the weekly, and then what do? We do this, lower into what? Discount, higher. Same thing here, discount, higher. Then we're in a ranging market, then we go higher, and now we're right here in this structure. Okay, so that's our swing point that I needed to explain because I haven't previously explained to you, and those will have a ton of liquidity. Also, the swings will have liquidity, yeah, but not the same amount as these ones. Also, the points, like I already mentioned, previous week's highs and lows will have a lot of liquidity, a lot. So if we see price take a swing high, swing previous week high, we want to see how price reacts on lower time frames, because how price reacts on lower time frames will tell us a lot about what price does. For example, we're taking this previous week high right now, right? We had a closure above it. Now, right here, we closed above, and we're looking like we're closing above it most likely, but we could close below. If we close below, we want to see other time frames, like such as 1 hour is bullish, daily is in a it's in a bullish structure, to be fair. Right here hasn't really broken it, and it touched order block and reacted. And also the previous candle closed also bullish, so this candle is most likely to be taken. With that said, there's a lot of liquidity here. Why here? Because here is the other day's high, which also has liquidity. Previous day highs and previous day lows will have a lot of liquidity, such as you can see here. We take the previous day high, we close below, boom, then we have big displacement lower, we break structure, then what we do, we do not go to the premium, and we go lower, right? So that's liquidity points as well. That's a lot of liquidity, and that's liquidity. Liquidity will be previous week, so you grasp it up. Liquidity will be swing lows and swing highs, previous week's highs, previous week's lows, previous day highs and previous day's lows. Go look into your charts, learn what I'm saying, and once you've done that, watch the video multiple times, understand what I mean with liquidity, why it's important, and how price reacts once it takes liquidity. We will, in further topics, we will talk about how to implement it into the strategy. But I want you to understand why we implement it like that and how price reacts. So when you are trading and you see price taking liquidity, you are not the liquidity. Okay? And what I mean with liquidity is all the places in which a previous buyer can sell its previous buys. So a buyer that was buying all the way here can sell to you here once, not you, but I mean other people, which are breakout traders or support and resistance, like, oh, we broke resistance, now it's support where I'm entering, you know, like, okay, all of those people will buy to them and they will be selling to them. Why? Because they do not care. Those people don't look into previous week highs, they don't look into previous day highs, previous hour highs, structure, etc. They're just looking into lines which they consider as support and resistance, which it might work sometimes, but in the long run it does not work as efficient. I'm not saying it doesn't work, I'm saying it does not work as efficient as learning liquidity, premium discount, and structure. Those concepts are what you need to understand when markets are likely to continue or fail. And sometimes you will be in the fail side, but if you can be in the winning side most of the times, you're good to go. Okay? So that's liquidity. I'll see you in the next.